Hi, my name is Darren Joseph from HEJ.tax, and we're the team that seeks to demystify that sometimes confusing world of international tax. And today I want to comment on that $5 million gold card that has been proposed by the Trump administration. So I'm recording this at the beginning of March 2025, and I'm commenting on a new visa that has been proposed by President Trump. I think it was on February 25th when he made a speech from the Oval Office. Essentially, it'll be a way for wealthy foreigners to buy US residency for $5 million. But not only would it be an opportunity to acquire US residency, but it'll also be an opportunity to start in a pathway to US citizenship. Of course, there have been lots of comments on this. We have no interest in the political aspects, just sticking with the tax perspective. If you're interested in the investment migration space and the global mobility space, that of course makes sense because sometimes you get the impression that there's a disproportionate number of observers who would like to encourage people to leave the United States as opposed to enter the United States. But the reality is, way more people are trying to get into the US than are trying to leave. And particularly when you're speaking about high net worth individuals, way more people. When you're speaking about high net worth individuals, the highest concentration of millionaires, centimillionaires, and billionaires are not outside of the US, but are in the US. One website that I enjoy spending time on, and I have no connection with this website at all, I just think it's a really cool website, and that's visualcapitalist.com. And what I'll do for those who are watching this as a video, as opposed to listening to it on a podcast, the links will be in the show notes below, but I'll also ensure that the charts are on the screen as well. And you can clearly see that when you look at the highest concentration of high net worth individuals, it's not as some people would imagine that they're all concentrated in some zero tax jurisdiction somewhere, but it's the complete opposite. Centimillionaires, billionaires, and millionaires are disproportionately concentrated in high tax cities across the world. And of these high tax cities, the highest concentration of cities that are home to high net worth individuals, yes, you guessed it right, is in the United States. So the idea of setting up or making that pathway for high net worth individuals to enter and to spend time and spend money and to enjoy that American dream, no doubt the demand is there. But what is often overlooked is the need for proper and diligent pre-immigration tax planning by a team that understands the jurisdiction that you're coming from as well as the US to make sure that you're optimized as you plan for both your jurisdiction of origin, where perhaps a substantial portion of your wealth would still be domiciled, as well as the US. And 6 strategies that we work with our high net worth clients to explore and potentially implement as they decide on a move to the US include the following. Number 1, something called PFIC migration. A PFIC is a term used to describe basically what are foreign mutual funds. And I'll give you the context of this. This came up in the 1980s under President Reagan and his tax reform initiatives back then. The US domestic financial institutions complained that there was a potential incentive for US tax residents to invest in foreign financial products, in that they're able to defer paying taxes until there's a distribution. And then, so you have an ability to compound, and obviously it'll be more attractive than most US domestic financial products. So in the 1980s, something called the PFIC, or the Passive Foreign Investment Company regime, was created. What it does effectively, it creates an anti-deferral element. So you can't defer recognizing the gains. And more controversially, if you're not advised correctly in how to structure and how to report this, there's some really aggressive throwback rules where you can be taxed at your highest marginal tax rate, plus interest, plus penalties, depending on what was overlooked. So by creating such an aggressive tax regime, what it seeks to do, arguably, as well as a reporting regime, what it seeks to do is incentivize you to invest domestically rather than internationally. Now, it is potentially a hassle, but it's not something that cannot be planned around once you have the right team working with you. So PFIC mitigation is a key tool that you need to explore and consider as part of your pre-immigration tax plan. Number two, accelerating income recognition. Obviously, when you become a U.S. tax resident, you will be subject to taxation on your worldwide income. If it is, for this type of product, for that type of high net worth individual, they tend to be post salary. So they are business owners as opposed to employees, right? So if it is that you are working on a deal and you have a big liquidity event coming up, et cetera, you may want to look at structuring your affairs so that income can be accelerated and recognized in advance if you move to the US, at which point you become a US tax resident. So that idea of as much as realistically possible, recognizing income in advance if you move to the US is something that we talk about with our clients. Number three, basis step up. Now, you're subject to tax on your worldwide income when you become a US tax resident. And one of the taxes that you'll be subject to, of course, is capital gains tax. Capital gains being the delta, the difference between the cost of an item and the amount that you realize upon disposal of the asset. Sometimes you are sitting on an asset with a large amount of built-in gains. So for example, a piece of real estate that may have been acquired decades ago in whatever country of origin you have, right? If it is that you move to the US and sell it after becoming a US tax resident, if you don't do anything, if there's no proper planning in play, then you're potentially looking at capital gains tax, not on the difference between the selling price and the value at the point in time you became a US tax resident, but the value at the point of time of acquisition, at the point of acquisition. So what we do is work with you in order to achieve some sort of step up in basis. So there are ways in which you can rebase the value of the asset to the value as at the point in time that you become a US tax resident rather than the value when you first acquired the asset. So basis step up is a key tool that we consider and explore in advance if you move to the US. A fourth tool that we use and we explore and we discuss with you would be foreign tax credits. Now that goes without explanation. That is the ability to plan, leverage, and properly deploy foreign tax credits is absolutely critical to avoid double taxation. So often we have clients coming to us, unfortunately, they may try to do it themselves, or they work with a team who's not sufficiently qualified and experienced, and they are double taxed. So foreign tax credit planning, absolutely important. Number five, qualified dividends. If it is that you're receiving income from a company in a jurisdiction with which the US has a favorable double tax agreement or double tax treaty, the dividends derived from that company in that jurisdiction would be subject to a lower tax rate. It'll be taxed as qualified dividends as opposed to being taxed as ordinary income. So if it is, again, you're successful, you have investments in companies all around the world, we can perhaps work with you and discuss that part with you, where there can be some sort of restructuring of your holdings in a way that takes advantage of the fact that dividends coming from some jurisdictions are more favorably taxed than dividends coming from others. Number six, which is last but by no means least, is the use of a trust. I purposefully left that for last, not because it's the least effective, but perhaps because it's one of those tools that requires the most forethought and advanced tax planning. The reason why is, again, depending on your situation and that of your family, in order for a foreign trust to have the ability to optimize your overall tax position, it needs to be planned, deployed, and structured well in advance if you move to the US. And some people, they may not have the time, in that their move to the US is more imminent than otherwise it could be. So yes, it is a tool that needs to be considered, but it needs to be considered way in advance of a move to the US, and it needs to be structured in a very precise and careful manner in order to achieve both the estate planning, tax planning, and asset protection benefits that you as a high net worth individual would need to enjoy. Again, if you want to talk about pre-immigration tax planning, please feel free to reach out to us. My name is Darren Joseph from HUJ.tax, and we'll see you next time.